Welcome back, Alpha Hunters. Okay, so this is going to be a pretty quick video as I'm doing a continuation on a quick guide that I showed off when I was covering some stock stuff. But this is the quick guide for the timeline of your trade. But I'm going to talk about the options side of it today. Okay, so this is the options side of it. Now you'll notice there's a lot of similarities and there's some differences between the stock and the options parts. But the main thing to understand is the long options positions and the short options positions is not like the long and short stock. These are directional plays, the long and short stock. Long options and short options, this is not a directional take, okay? This is long and short options is not an indication of direction. Long options is buying to open and short options is selling to open. This also does not take into account combinations such as verticals, butterflies, condors, pretty much anything like that. So it's not talking about any kind of combinations. We're just talking about like a single position. Are we buying it or are we selling it to open? Okay. The two groups of people I really wanted to focus on with this quick guide here is one, new investors and new traders. And the other is those that are looking to become more consistently profitable. If you've been trading for a while and you have a hard time becoming consistently profitable, this is gonna probably help you a lot in understanding how to set up the timeline of how long you should be in a trade, what kind of charting time should you be looking at for how long you should be in the trade. And that was kind of the whole point of this quick guide, is to bridge that gap of what charting time should I be looking at for how long I should be in the trade. And another thing to be mindful of is the time that you're looking to be in the trade. I have kind of at the top, I got 4 columns up here. So for day trade or an intraday type trade, that's what this first column is. Second column is a short term, which is up to about a month. Long term is 12 months or plus. And then the medium term is obviously going to be everything in between the short and long term, which is 1 month to 12 months. Now, this is just what I deem. I've broken these categories down into. You don't have to break them down this way. If you have like your own different criteria to how you break things down, perfectly fine. And to understand the color coordination that I have picked out here is obviously we have green, yellow, and red. Red are just really no-go areas. Yellow are conditional areas, like you got to have certain kind of conditions met to really be effective in those areas. And the green boxes, these are generally pretty safe areas to put on trades. So when I was first helping a buddy out and explaining this on the stock side, he had a hard time understanding, because what I mean by these 1 to 5 minutes, these 15 to 60, and the one daily, the one weekly, and the one monthly, those are the ones you see out here. So what I mean by that is on your charting screen, each candle represents the time frame that is associated with this box. So for the short term, if you want to do long positions, you want to look at short term, you want to use like the 15-minute candle, the 60-minute, and the one daily. Now, what I mean by that is each one of those candles on your chart, it should be a 15-minute representation, a 60-minute representation, or a one-day representation. And the disconnect that we kind of had is his broker doesn't have charting the way I'm used to using charting with TradingView, and I'll show off more clearly what I am talking about just when I get done covering this quick guide. And I'll switch over to TradingView and show you what I'm talking about. The way his broker uses charting is it brings up like 2 whole years up on your screen, and it might be a weekly and it might be a daily, but that's how his broker uses it. So if your broker does do that, just understand that this is what I'm meaning when I have 50, 60, or any other kind of time frame up here. Okay. So for this long options position, I definitely almost labeled this one orange, but I wanted to stick to just the 3 colors. There are some great opportunities with buying calls or puts on intraday kind of perspective. That does make this time frame can be pretty profitable, but you are very much looking for certain conditions. Okay. Also, buying or going long on options within a month. This also requires some experience. Some certain conditions need to be met, and that kind of thing. as theta is a little bit more of an impactful factor here on the short term. But for the short term, you'll most likely be using a 60-minute or 1 day, but you can definitely use a 15-minute to help set up positioning and order entry, that kind of thing. So then on the medium term and long term, we got green boxes here. So this is generally going to be a little bit more of a safer area to trade and invest when you're looking to buy. And if you were using the medium term, I would say definitely want to stick to 6 months or longer. You're going to be closer to the longer term kind of time frame, and you'll be using mostly the 1 day or the daily candles, or you can also be using the 1 week. And then anything long term, you'll be using a 1 day, 1 week, 1 month kind of time frames for candles. And then shorting options. So we got 2 red boxes here, just like shorting stock. I wouldn't really do this at all, as that's not the whole point of selling options or shorting options. Selling options, shorting options, same thing. The whole point of that is for theta decay. And so when you're selling options on like longer term stuff, well, you're not getting that theta decay. Sure, you might lock up premium, but it takes a long time to realize that premium. And that's the whole point, is we want to realize premium when we are shorting options. So with the short term, and we're selling options or shorting options, the charts that you want to look at is 60-minute or the 1 hour, same thing. The 1 day, and I know I do have the short time frame up to a month, but you could definitely go a little bit past that, not too much. You definitely want to stick in the medium term time frame. You want to stick a little bit closer to the 1 month area. 45 days is a good spot to sell some options. I would not go past 2 months though. 2 months is the max. Don't go past that. And then for shorting options on a daily or an intraday perspective, use the 15-minute, 60-minute, 1 day, that kind of thing. What you're looking for is stocks coming into support and resistance levels where they probably will have a hard time breaking through, and you are selling options typically on the other side of those pivot points or those support and resistance areas. Now, some of the cool things about selling options in the short term or on the daily perspective is if you do sell options and the market does move against you, but you're kind of like, okay, I'm not too worried about it. Over the next couple days, it'll probably come back. This is where you can roll out options. I'm not going to cover that here, but it is very advantageous to protect capital and just sell options short term and not have to worry about having a lot of capital at risk. Now, what this doesn't factor into is, like I said earlier, this does not factor combinations and those kinds of things. So if you sell a vertical spread and the market does actually go and take the vertical spread you sold, it's going to be really hard to kind of recoup those losses. There are ways to roll it, but you're just having to put more capital up front. Just be mindful of that. Okay, so here we are looking at TradingView, and what I mean by each one of those boxes, with the 1 to 5 minute, the 15-minute, the 60-minute, the 1 day, the 1 week, the 1 month, what that represents is each one of these candles, and I'll zoom in for you here. So each one of these candles represents that time interval, okay? So right now we are looking at a daily chart on the SPY, okay? And if I was to switch this over to a 15 minutes, so right, 15, it defaults to 15 minutes, so you actually don't have to put in the M here for the SPY or for TradingView. So 15 minutes, so each one of these candles represents 15 minutes, right? So we can look at a 5 minute, this is a 5 minute, this is a 1 minute, okay? So these are all, this is what I mean by those time intervals in those boxes to kind of help line up what you are looking to do within a certain kind of trade time frame. Like if you wanted to be long something for, maybe less than a month, an hourly chart, not bad to look at. You can trade a lot of things on the hourly chart, that kind of thing. But one area where it does matter and kind of how you do set up your charting is longer term type stuff, okay? So if I zoom out here and I show you a monthly chart, so if you want to see a weekly chart, it looks the exact same thing, right? Just each one of these candles just represents a week, okay? But a monthly chart, the thing about a monthly chart and long-term charts, or stocks that have gone a rapid increase in price, and I'll show Tesla here in a second, and what I'm really talking about is you need to have logarithmic chart, okay? you need to have some way to probably toggle that at least. And I just have it always toggled on, because when I zoom out and see a longer term perspective and I turn logarithmic on, and if I only have price scale on, then it just looks like the S&P is parabolic, right? And that's not an accurate representation for the way it compounds, okay? So if you turn logarithmic on, and what that does is it makes it comparable to percentage returns from the previous, like the older price periods to the more recent. So it makes it comparable on a percentage return basis, okay? Because the market's not going to keep going up at 1% based on what the price of the SPY was back in the 90s, where it was at 50 points, right? 1% back then was 50 cents, where 1% today is roughly $4.70. Okay, so that's 10% of what it was back in the mid 90s. So that is why having logarithmic charting on is very important, or some way to make it comparable. That way you're not just looking at a price comparison on charts, because it just looks parabolic. And I'm going to give one quick example of that on Tesla. Okay, so this is the chart of Tesla. So the monthly chart for Tesla goes all the way back to early 2010, and we can see that it's had a pretty good run. It doesn't look anything abnormal. Had a pretty good run here. It's had a really good run over the past 2 years. Okay, so if I turn off logarithmic scale, it just looks parabolic. I mean, because that's the past 2 years dominated the price in which it has increased so much. You don't even notice that move it made back in 2013, that bullish move it made back in 2013. You don't even notice that, right? The move it made back over here, it didn't even register, really. So this is why having a logarithmic scale on for stocks over a longer period of time, definitely, and then stocks that have had great price appreciation, you definitely want to have something of logarithmic type scale on to gain that perspective for the longer term. Okay, so whenever you're looking at a lot of data for a daily type interval or a weekly or a monthly, you're going to want to have some way to have logarithmic on. And I just always have it on, because on the short term it doesn't really affect the charting too much. I did want to share that point, that logarithmic is very important to have to just kind of get an understanding of longer term trends and that kind of thing. And if you want to better understand calls and puts, click that video in the top left. Alrighty, take care, Alpha Hunters.